Thank you. Welcome. And she will be joined by a distinguished group of panelists. Ran E, co-founder of Orderly Network. Please come up to the stage. Welcome. And we have Jacob from Bishklar, co-founder and CEO of Clearpool. Christian Friesa, co-founder of Blatt. And we have Cher Chong, co-founder and COO of ZO. Thank you. So, dear panelists, the floor is yours.
Thank you so much. Good morning, everyone. It's great to be here in Seoul. Very electric out there. My name is Nikita Sachdev. I'm the founder and CEO of Luna PR. We're a PR and marketing agency headquartered in Dubai with offices in London and New York. Been in the space since 2017, and this is my third time in Korea. Very excited to be here. And today we're talking about the backbone of DeFi, which is liquidity. It fuels the markets, but fragmentation and rising interest rates from traditional finance are maybe pulling the money out of DeFi. So I'm really excited to speak to my panelists about this very important topic and how to scale this industry. Before we begin with the questions, I'd like for the panelists to introduce themselves.
Hi, I'm Rand, co-founder of Orderly. We're the exchange layer that unifies liquidity in perps across 18 different blockchains. We've processed almost 150 billion in total volumes since inception. And yesterday we launched a very interesting product called Orderly One that allows anyone to create your own branded perp DEX on top of our infrastructure in a span of minutes without any line of code, which, if you're a creator, community, KOL, you can do this all with no code permissionlessly. Thank you.
Thanks for having me. My name is Jacob, and I'm the co-founder and CEO of Clearpool. Clearpool is a credit marketplace, and we mainly source liquidity for, stablecoin-enabled fintechs. We are around since 4 years. We've done overall about $900 million worth of loans. And currently we have a big focus on payment financing, so sourcing liquidity to enable instant cross-border payments. And that's basically our big focus. And we're creating yield products that are based on yield derived from payment flows.
Nice to meet everyone. My name's Tristan. I am the co-founder of Bullet.xyz. We were formerly known as Zeta Markets, and we'd processed on Solana over $15 billion worth of trading volume for over 100,000 users. We were one of the very earliest teams building on Solana since 2021. And with Bullet, essentially, our goal is to build a uncompromising professional-grade perps trading experience via our Layer 2 rollup for Solana. And so some of the statistics that are most interesting is we can get trade execution time down to 1 millisecond. So this is very good for market makers bootstrapping liquidity on exchanges and encouraging more high-frequency trading to come to DeFi. And so we're pretty close to getting to mainnet, and so we're excited to kind of talk more about that and show what we have.
Hi everyone, I'm Cher. I'm the co-founder and CEO of ZO. ZO is actually one of the first intelligent perpetual trading DEX on Sui. We've been running for about 6 to 7 months in terms of the new rebranded perp DEX. We are doing around 800 million volume. We're running on an AMM model. Yeah, we are pretty new on Sui, and we're excited to offer zero slippage, very quick and transparent transactions on Sui.
Amazing, thank you. Let's do a quick pulse check with the audience right now. Raise of hands, how many of you have provided liquidity into DeFi previously? Show of hands. Okay. And how many of you have pulled out because the risk to rewards didn't add up? Okay. So interesting to know where we stand right now. I'd love to know from the panelists, what are the biggest obstacles in to provide healthy liquidity in the DeFi space right now?
I think like with AMM models, right? That's the first. It's impermanent loss, right? There's these types of things, but with more advanced liquidity provision, like with now the vaults on perp dexes, it's single asset models, and the yields are more stable. So there's less, but then you just have to worry about smart contract risk and such. But I think those are like the next generation types of liquidity provision, where you have a more professional market maker that you're essentially giving access to, and there's some sort of a rev share. So I think those are pretty good. We actually have one called OmniVault. It's a 20 million TVL in there, accessible from 3 different chains. Historical APR as of today is 28%, less than 20 basis points of total drawdown in the past 6 months, managed by our partner, Kronos Research. It actually integrates Cefu, so allows quoting on orderly and hedging on Binance via Cefu Mirror, so it's pretty innovative in that sense. You can check it out. Thanks.
I can actually add to that as well. So we have around 4 vaults, LP pools right now that's available on our perp dex, and just like what Ren said about offering stable yields. Yeah, so we're offering about like 20% on USDC pool. It only has a single USDC asset for that, and people are actually earning, pretty consistent stablecoin yield if they're, a bit risk averse. Obviously, as a SUI perp dex, people want to have, SUI incentives. So we do have a very heavy SUI pool LP that offers to, SUI supporters. We have around 90%, and we're often adjusting the percentage of that with, deep and warrants and a little bit of a native SUI tokens that are in the pool as well. So people are actually earning around 40% on that historically. And we just actually introduced a new BTC pool that we're doing with a third party as well. That's cross-chain liquidity. And we're offering about 3% yield there for BTC. And we're actually doing more and more of these pools as we're talking to more stablecoin issuers. We're talking to other exchanges that wants to do their stablecoin, essentially that wants liquidity on SUI. So we're constantly adjusting the fees. We're constantly figuring out how LP can get consistent interest and yields. And we're thinking of deploying our own delta neutral strategy vaults that I thought could be interesting in stabilizing LP's interest.
Yeah, I can add to that as well. I think AMMs have kind of been the de facto thing over the last couple of years, especially on Ethereum with slower block times. It makes it really easy for people to provide liquidity into markets. You basically provide, two-sided liquidity into a pool. Like Ram mentioned as well, like sometimes the impermanent loss is a problem there in terms of profitability, and it has to be subsidized either in fees or some extra token emissions. So we've always been big fans of central limit order books. I think it gives you much more expressiveness and flexibility in terms of how you provide liquidity ranges. You obviously have CLMMs as well, these constant liquidity kind of market makers. But for clubs, it definitely has a high level of sophistication, typically caters to more professional market makers who already kind of run a firm, like you mentioned, Kronos Research, a good example of that. So there's a much smaller pie. It's harder for retail to get into that. I think vaults are a really nice way to do that. Obviously, you kind of democratize it. You can kind of run a bit of a strategy in the background and let people actually provide into that. We've also made a bunch of architectural changes on our side with our exchange because we found that professional market makers doing stuff purely on-chain have to typically compete with MEV, priority fees, and stuff on Solana that are getting quite expensive. It's also hard to necessarily be profitable all the time because of these discrete 400 millisecond block times. It's very different to traditional finance or Binance, where things are more of a first in, first out prioritization. Things happen at very high time frequencies, so 1 or 2 milliseconds essentially. DeFi, even on Solana, is still 400 milliseconds, so call it 200 to 400 times slower. What we've built with Bullet, being kind of a layer 2 on Solana, is we get this very fast execution, which should provide much better profitability, I think, for market makers, much tighter spreads, much better depth, and so that's what we've been targeting.
Yeah, maybe from my side. So I guess I'm the only one who, who's not a founder of a DEX here. But what we're trying to do is we're trying to bring private credit on chain and make it DeFi compatible. And I think there, with real world assets, the only real kind of like product market fit that that then also had liquidity were, tokenized T-bills so far, I guess, right? So anything else was a little bit of a mismatch. And the main reason is if you are, financing receivables in the real world, usually you're financing several months of receivables, so the underlying is very illiquid. And as a result, it's very difficult to create a market for these tokenized assets. So at the beginning, everyone thought, okay, you're basically tokenizing a private credit fund with a 1-year duration, and then you can trade those receipt tokens and create liquidity. Guess what? That didn't really happen, because if the underlying is illiquid, it's very hard to build a market. Now, this is why we are currently focusing still on real-world financing solution, but we are focusing on the shortest duration of financing, which currently is payments. There you're financing like a few days only, and as a result, you can create products that are a lot more liquid, and then you can create products that are can also have a secondary market. Because if someone makes a market for an RWA that can be redeemed within a week or two at a discount, that's possible already, versus something that is 1 year. And then I think the holy grail here is to create a product that can be that is real world financing, not crypto related, but then feels and looks like DeFi and can be used within lending markets. And then you can have all the advantages of leverage, etc. So that's kind of like what we're focusing on, and that's the big problem, I guess, we want to tackle, and we think there's a big opportunity as well.
It's great to know the individual obstacles that you guys are facing within your companies. I would like to know more on like a broader scale for the DeFi industry. 2020 seemed like the heyday for DeFi. Personally, I used to yield farm, and I was quite involved, and I kind of fizzled out as well. And from my initial poll, the very few people in the audience that raised their hands, it seems like a lot of people have kind of also retracted back. I'm curious to know, are you still seeing the sentiment is strong? How is the appetite with the retail audience right now in DeFi? I mean, if you come to think about it, in American markets, you're getting 5% interest rates, right, on traditional finance. And DeFi holds so many risks. There have been so many hacks and exploits. So how are you finding the retail audience appetite in the DeFi space right now?
I think it's inevitable that all finance comes on chain. So I think that trajectory is very clear to me, starting with stablecoins, which arguably has the best PMF, right? But you can see RWAs coming on chain, all types of them, not just yield generating, but like stocks and such. So it's just a much better infrastructure to settle, to as a ledger and to trade all types of assets, right? Not just crypto. So that's all happening. So I think one platform that trades everything, even like permissionlessly, is kind of inevitable, and eventually that replaces a lot of the TradFi infrastructure. I think that's so. Then the adoption is, I think it's fast. For example, one of the dexes that built on top of us called Aiden is this actually a big live streamer in Korea called Inbom, and he kind of single-handedly converted a lot of centralized exchange users to DeFi via his dex, because he's got a lot of followers. And it's about the experience, the UX, and just the things that you care about in centralized platforms. I think as DeFi UX gets a lot better, it's kind of a no-brainer, and you can see that with the centralized exchange founders, right? That they're all kind of pivoting to DeFi because this is inevitable. And then by using the blockchain and it's scaling, it's like you're saving a lot on infrastructure costs and people. You have a team like Hyperliquid, 11 people, and they've done so much, right? So I think it's very difficult for CeFi to compete with DeFi at some point, just on the cost levels alone, right? So.
That's good to know. And I want to get your take on retail audience appetite as well, but I just want to elaborate on a point that you mentioned, Ran. So you said it's inevitable that all finance moves on chain, and I agree, definitely. However, how are we going to balance the regulation that's required from these institutions coming in that'll help push this industry forward with innovation and the need for decentralization?
Yeah, I think now is like the best time. You have the U.S. being very pro crypto, pro DeFi, right? So, I mean, I think regulations kind of follow. They tighten up when something bad happens, right? Knock on wood, that hasn't really happened in DeFi yet. But I think now is like the best time to be like a DeFi founder because you can really push the limits on what you can offer, focus on the product and growth instead of worrying too much about regulations, and that'll all come. But I think now is, and there's various things that people are working on, right? Like like ZK KYC, different compliance ways of compliance with authorities for DeFi protocols. So there's various things that can be done. But I think now is the time to like push hard into the building DeFi.
Right. Tristan, you were going to say something earlier?
Yeah, I think back on your point on retail appetite, like I got into the space more full time in 2020. And yeah, there were plenty of opportunities around, but I think the landscape has shifted quite a lot. To be honest, like why I got into DeFi is we started building as an options platform. We looked at some of the ones that were on Ethereum. They had maybe 5% spreads. The Ethereum gas fee to actually like post a trade on these on-chain order books was like $20. And for me, it was just like, that is like cost prohibitive. I never see this kind of scaling. It's markedly different to these days. You know, perps platforms maybe 4 years ago, it's probably like only DYDX and a few others. Maybe if they were doing 100 mil of daily volume, that was astronomical. Now you're seeing platforms like Hyperliquid, Lido, Asta doing $15 billion of volume a day. So I think the pie has grown incredibly large, at least on the perp side of things. Also my perspective being in Solana, for the last couple of years, there's just been like a huge boom, I would say, especially last year. Meme coins, yes, driving a lot of it, but Jupiter has done almost $1 trillion of volume to date. So I think there's just been like massive wave of retail interest. And there's pretty good yield opportunities these days as well. A lot of these T-bills coming on chain as well, starting to match with like TradFi and the expectant yields there. So I would kind of argue that things have definitely improved over the last couple of years and there are more opportunities than ever.
Yeah, I want to add to that as well because like I was just in New York about a month ago and I was talking to these regulators or potentially like attorney that are running for New York representative of our attorney, and I think perps is still kind of like a gray area for them. It's not very clear and transparent to them that it is under protection from retails and infrastructures and institutions that are trading perps potentially because it's not in the regime that it is clearly defined as a financial product. So I was a little bit, curious about that too, because we want to make sure that U.S. traders can also trade on us, and we want to make sure that terms and conditions are stated clearly, just in case there's any legal things that come at us later, because we do have a lot of U.S. traders. But I think that's interesting because a lot of delta neutral funds in New York, Web2 capital that are coming in with large amounts of BTC, they might have seen the DeFi boom before, and I'm sure that people know that there's a lot of hacks going on previously with DeFi protocols. But what's a little bit assuring for them is that they understand perpetual futures in traditional sense very well, right? They understand how it works. They have been looking into it for a long time. That's what they're familiar with. And so then it doesn't feel like they're, just deploying assets onto a pool that they have no idea, have no transparency on, where their assets are segregated or distributed to and how they get the yields from. And which is why I think, having a transparent data kind of view on how perps DEXs are running right now with AMM models are actually interesting for them and a little bit more familiar for them.
Yeah, maybe I think on the RWA side and on the yield side, I think one big trend, as Rand mentioned, is obviously stablecoins probably have the biggest product market fit, and it's becoming it used to be just a tool for trading, right? To have a stable trading pair. That's how stablecoins started. But now stablecoins are becoming so much more than that, and stablecoins have real use cases. outside of our crypto native world, right? Like in Latin America, people are now holding stable coins because they want to save in US dollar and in US dollar denominated yield products, maybe because their currency is weak. Companies are transacting in stable coins because there is cost advantages. So there is this whole big new crypto adoption that is completely outside of our crypto native world. And I think that's very exciting because once stable coins are widely adopted and people are holding them, now we see, fintechs, digital banks, card products, they're all built on stablecoin rails, and people are holding stablecoins, and then if you have stablecoins, automatically it is easier and more cost efficient to buy a tokenized asset, tokenized RWA, or to deploy into a crypto native strategy, whatever that might be. And I think that's the next big opportunity is not just tapping into crypto native capital that to some extent is still rather limited, I would say, but to really tap into the Web2 world. And now you see there's also big digital banks, big Web2 fintech players that are basically launching Web3 products. And the key thing here is I think those guys are probably going to solve for user experience, because the user doesn't really care whether this is a tokenized asset or whether this is a non-tokenized asset. The user just cares about the yield and the user experience. And I think that's the next big opportunity that we're seeing. And I do think that, generally crypto always had a bit of a user experience issue. Definitely, I think a lot of the new products, they look and feel more like centralized products. But it is still, rather difficult for an average person to, set up a wallet and do all of those things, right? There's still like a lot of people that are excluded from that. So I think the next wave is really coming from this UI, UX improvement and from the Web2 adoption for people that are not crypto native and just use it as an alternative to their current, banking and investment products.
Yeah, for sure. I mean, I just also came back from New York and Washington, D.C. I was there for a month, and the discussions just surrounded around stable coins, RWA, tokenized treasuries. Do you think, Jacob, this will be the driver for DeFi in the next coming years right now?
Yes, definitely. Definitely, I do think so. So, it's probably one of the biggest subjects. We had the first, tokenized T-bills that came on chain. Now we have stocks coming on chain. I think in the future, all assets are eventually going to come on chain. But yeah, the yield landscape and it's going to change, right? It's not going to be about, farming 50% yield in a native token, most likely, but it's really just about, using the blockchain as an infrastructure to optimize costs for bringing this type of products on chain. And, in the future, it's going to be exciting as well. Maybe we'll have, more illiquid assets as well that are going to be brought on chain, and maybe even real estate is going to have its moment in the future. Yeah.
But I guess Clearpool is also surrounded around these topics as well. So curious to hear from the other panelists on their take on stablecoins, RWAs. Is this going to be the driver for DeFi?
It's definitely, yeah, because that's the majority of TradFi assets if it all comes on chain. Like, we're working on getting all types of RWA as collateral. I mean, it's really good as collateral for perps, right? Because it's not correlated to crypto. It's not that volatile. People don't get liquidated as much. And like stocks, bonds, just like how they do it in TradFi, you can use it as collateral for perps, right? That's really good. And then we've got a lot of requests for RWA perpetuals, like single stock, index-based. People want to be able to trade, stocks on leverage 24/7. It's these types of demands that fields, and it's also not correlated to crypto. Like, I think the dollar's moving a lot these days, so then FX. So I think everything on one platform to trade on leverage, this is kind of what people want, and use all types of things that you own just as collateral or get yield. I think this is kind of where the demand is.
Yeah, actually, when I was in New York, I've been getting a lot of different approaches from New York funds just because they wanted to deploy their own stable coin as an asset manager or as a private equity that has a lot of BTC assets or traditional assets that they raised from their partners, their liquidity partners, which I found very intriguing because obviously it's my first time running a prep desk as well. But to see that the demand is actually here, that they would want to have their own stablecoin and they want to bridge it to different chains, and obviously Sui is one of the ones that they're interested in, which we have very close connection with, and so it's kind of like education and onboarding at the same time, because then you would you'd be able to tell them, hey, so you would have to, bridge it to the foundation this way, that way, and then how we would, unwrap it, and then create a pool for you, and then we would discuss on the yields that you want to provide, and then essentially, they would want their coin to be traded, especially, to have volume, right, on prep dexes and be traded on DeFi, and potentially about stocks tokenized. Being able to trade, 50x or even 100x, depending on, kind of how your exchange would be able to tolerate these kind of volumes, is quite interesting to see of it all kind of in a one station stop situation where you would get maybe a tailor-made, yield from these issuers that you probably wouldn't be able to find anywhere else. So it's interesting user experience for sure.
That's good to know. I was just going to ask about what you felt about the institutions' appetite in DeFi. What exactly are they looking for? Like, where do you see they're really interested in the DeFi space?
It's a good question. I think definitely stablecoins have obviously been pretty big. I think some of this stuff, I think, in terms of like tokenization of stocks, which has been coming to Solana through X stocks, has been pretty good. I think trying to kind of get to base parity with traditional markets, I think has been pretty interesting. On the institutional side, we are definitely seeing a bunch more interest, even from more traditional firms, on trading, perps trading and stuff like that, which we definitely didn't see back in the day. I think people were very hesitant with smart contract risk and things like that, but I think things have become more normalized and things start to feel more on par with centralized systems. And so I think, just kind of this lindiness of these platforms being out for a couple of years, and some have gone down, but a lot have kind of survived through that, I think gives a lot of these institutions, at least trading on chain, a lot more confidence. We've definitely had much better conversations, I think, these last year, rather than like, in the early days, I think people are very cautious, especially some of the very big firms who do like massive numbers in traditional markets. Now they want to come on chain. They see the opportunity there. They see a lot of people trading. It's obviously good for you as a market maker to be kind of quoting these spreads, and you can actually be profitable. So I think where the opportunity is and where the innovation is happening is where the institutions are going to come to.
Great. Well, we have time for one last question. What is one metric that you think the audience should pay attention to that shows that DeFi liquidity is getting stronger?
Probably TVL, I think.
TVL is a very good metric. Yeah, maybe you can tell the audience a little bit about what that entails, educational purposes.
Oh, I think for any protocol, like a sign that real users are there is the amount of assets, right? For centralized exchanges, DEXs, you trade where you deposit your assets. So I think that's a better metric than something like volumes, because volumes can be faked, they can be wash trading, so it could be misleading. So I think TVL is kind of is real, right? So I think that's a pretty good metric.
Yeah, I think for me it's just like actual liquidity, being able to trade into certain markets and looking at the slippage either on the AMM side, which I think, at least speaking from the Solana side, a lot of these kind of prop AMMs, dark AMMs have actually improved things quite a lot. Whether you agree with that philosophy or not, they have tightened up spreads to something that is very comparable to centralized exchanges. And then these new club dexes that are coming out, we've obviously been big proponents of central limit order book dexes because we really believe those give like the tightest spreads, the best depth. And I think it's been really encouraging seeing some of the kind of forerunners in the perps DEX game starting to get very liquid. You know, when you actually start to trade on some of these top platforms like a Hyperliquid, you can market order, you know, over $1 million in size on most of the markets and not generate a lot of impact on funding or kind of blow out the order books. I couldn't say that a couple of years ago. So I think it's really cool that more people are providing liquidity. There's obviously a bunch more volume in TVL that's kind of running into that. And I think more people are coming to DeFi as their primary venue of choice.
Yeah, and I think that right now is kind of like a perp DEX season. You know, you saw Aventus, EdgeX, Aster that's launching, and you know, there's a huge influx of models that are coming in from, you know, that's operating in Club and GMX that are kind of competing against each other, but then also kind of trying to prove, you know, who's better in terms of driving the most liquidity and volume. And I actually believe that this is a very huge pie because, you know, traditional assets are coming in, and, you know, with perp DEXs being a little bit more mature in crypto, you know, it's going to be very intriguing to find out, you know, which you know, model is most attractive to the users.
Jacob, any final words?
Yeah, I think for the RWA space, the key thing is really, you know, to create more use cases. And I think the biggest use case is using assets as collateral. And so maybe, you know, liquidity that you have on, you know, lending markets, such as Morpho and Euler. You know, there is basically these isolated lending markets that are specifically designed now for RWAs. I think that's a good metric to see that, you know, RWAs are also getting more liquid and useful than in the past.
For sure, yeah. TVL, use cases, slippage, liquidity, all of them very important. Thank you so much for listening to our panel, and you can catch us outside if you want to chat further. Thank you.
Thank you very much. Thank you very much, our moderator and panelists, for insightful and rich conversation. Thank you.